What do you guys think? Should we get started?
Yeah, let's jump into it, Nathan.
Well, I think we definitely should. Well, first of all, welcome everyone. This is going to be a kind of a unique opportunity that we have here to talk about new tax laws coming up for 2021 and some of the changes, especially with the differences of now having a Democrat president, maintaining a Democrat-controlled House, and kind of still an unknown with the Senate. But what we really want to talk about now is year-end planning you can do today, especially with you as a business owner, and how that relates to your business, or even how that relates to you personally and your family. So that's what we're going to be getting to. My name is Nathan Crampy. I'm going to be one of the presenters today, but realistically speaking, I want to turn it over right away to our first presenter, Nathan Nelson. Nathan, he is the managing partner and co-founder of Virtus Law. He is fluent within estate planning, and furthermore, he graduated summa cum laude from the Master of Law in Taxation from the Thomas Jefferson School of Law. Nathan represents businesses and high net worth individuals while overseeing the estate planning and taxation department in the firm. Whether he is arguing in front of the Supreme Court in Minnesota, he's also on the radio, and he's also reading and publishing numerous articles. Now, he strives to not be as boring as what all of his credentials critique and say. So with that, I'm going to turn it over to Nathan. He's going to have his presentation right now, and then I will take over after him. And right after that, we're going to have plenty of time for questions and answers and go through questions that you have. So be writing down ones as we go. With that, Nathan.
Thank you, sir. I am going to stop sharing your screen, Nathan, so pull up mine if that's all right. And so, everybody, welcome. This is going to be a little bit of a splitting it up into two categories. It's kind of the asset differential because of the tax changes and the income side. I'll be covering the asset side. Nathan will be covering the income side. And so on the asset side, we oftentimes use estate planning techniques to manage that. So I'll go quick, but in short, current exemption amount is about $23 million that was signed into law in 2017 under the Tax Cut and Jobs Act. President-elect Biden has said that he would go as low as 3.5 million in assets. So what that means is if you have any assets above 3.5 million at death, those would be taxed at a higher tax rate. He has talked somewhere in the 45 to 65% range. If he does nothing, the $23 million estate tax exemption sunsets January 1st, 2026, and it goes back to 5 million. But we do fully expect, based on his tax plan, that he's going to strive to reduce that amount as soon as possible. The Tax Cut and Jobs Act says that there's an anti-clawback rule. So what that means is if you do some gifting now or some transferring now before the end of the year, the IRS can't come back and say when you pass, hey, you've got $15 million assets and the current exemption amount is $3 million. They take into account when you gifted it and what the exemption amount was at that period of time. So what does this mean for a business owner? Well, you use it or you lose it. If your estate could be subject to an estate tax because of asset size, or we're thinking that there's going to be appreciation over your lifetime that might put you above that limit, it might be a good time to think about using some of these strategies I'm going to talk about to get these things out of your estate. So we're going to cover 5 things. I'm going to go pretty fast, but a grantor retained annuity trust, an installment sale to an intentionally defective grantor trust, a spousal lifetime access trust, a charitable lead annuity trust, and an irrevocable life insurance trust. So first up, we've got, we'll call it a GRAT. So a GRAT is a great way to transfer appreciation of assets to beneficiaries without using any of your estate or gift tax exemption. How it works is a grantor transfers assets to the GRAT with a specified term of years, might be 5 years. At the end of each year, annuity is paid back to the grantor, and you get some interest with that. Any amount remaining after the payment of the annuities goes to the beneficiaries, free of estate and gift taxing. The annuity payments can be used to fund successive grants. We call that a rolling GRAT. So how does that work in practicality? Let's say you've got $1 million of assets with a 0.8% rate with a 3-year term. You're going to transfer that to an irrevocable trust. You see on the slide, I've got the return on investment there that you're taking in an annuity. So total, you get about $1 million back. After an initial term, the trust pays out to the beneficiary. So might be planning for kids or grandkids. With 5% ROI, they'd get $95,000, 10%, $221, 15%, $363. You may put that into a trust for beneficiaries. The great thing about this strategy is that it allows us to take this asset that might be growing in size, and essentially we're freezing the value while providing long-term. Great for an appreciable asset. Next up, we'll call it an installment sale to an intentionally defective grantor trust, an IDGT for short. It doesn't mean that the trust is defective, but it means that you as the grantor, you retain it for federal income tax purposes. This is also good for appreciating or income producing assets. We often see it for real estate investors who've got a really nice portfolio in real estate. They'll use this tool. So a gift of 10 to 15% of the assets being sold is added to the trust. So the IRS does not treat this installment sale as a gift to the trust. Any appreciation income produced by the assets sold by the trust will pass through gift and estate tax-free. The interest payments on the installment note are not taxable income to you because you're treated as the owner of the assets. There's no capital gains recognized when the assets are sold because, again, you're selling to yourself. So let's take a look at what that looks like. So you gift a seed of assets and then you sell other assets to the IDGT. So let's say you've got $1 million in assets to be sold to the IDGT and you use $100,000 in seed money that you set up the trust for. There's a 9-year installment note where it's being paid back with 1% interest. So in total, it comes out to about $1,046,000 in principal and interest. Again, you're taking back an installment note equal to the fair market value of the asset sold to the IDGT. But all of that appreciation passes to the IDGT beneficiaries. So again, under a 5% rate of return, the appreciation to the beneficiary is going to be about $200,000 with a 10%, $475,000. This is great for other those really great income producing assets that you might have. Next up is a spousal lifetime access trust. We call it a SLAT. I love SLATs. They're just such a great technique. So you gift assets to an irrevocable trust for your spouse if you're married, and other beneficiaries such as children, grandchildren. You have to name an independent trustee who makes these decisions to your spouse. You then use your current gift and estate tax exemption when making these gifts. Any and all appreciation of those assets passes to your spouse and your beneficiaries free of future gift and estate taxes. So you get to use all of your available exemption amount to lock into this, this historically high exemption amount of over $23 million. You can lock in at the current value of it. You and your spouse can both create a trust, naming each other's beneficiary. There's some restrictions on that called the reciprocal trust doctrine. That's something for another day. We can talk for hours on all the minutiae on this. But as a bonus, all the assets are protected against claims of creditors. So if we're worried about nursing homes or those kind of things, this offers full protection for that. So how does it work? You fund the trust with money or property. Could be both. Could be either. Your spouse is the beneficiary. Descendants can be additional beneficiaries. Then, after your spouse dies, the assets get distributed to the benefit of the additional beneficiaries. Again, either directly or it could be held in them for trust if you have minor children. Essentially what that does is it provides a great way to provide for your spouse, offer nursing home protection, capture appreciation, push it outside of your estate, and offer full protection. A charitable lead annuity trust is similar to a grantor retained annuity trust in that first one we talked about, but the annuity payments transfer over to charities rather than you. So if you know, look, I've got assets, I've put them in certain techniques already, and I'm getting income, and I don't need these annuity payments. I'd rather fund a charity that I find really valuable to me. A charitable lead annuity trust is great for that. One of the cool things right now is the IRS has historically low interest rates. And we can easily pass appreciation to the beneficiaries free of the gift and estate tax. We get to take advantage of those low interest rates. The trust can be structured to qualify you for both income and gift tax charitable deductions. So you're actually taking a tax deduction for all of these. If you've already established one or you have a family foundation, the family foundation can receive these annuity payments. So it's a way to benefit the family and take the tax deduction as well. So how does a charitable lead trust work? Well, first, the grantor establishes the irrevocable trust. We fund it, right? $10 million of assets with a 20-year term, 0.8% interest rate. The charity is going to receive either a set amount of money per year or a fixed percentage for a specified period of time. So in our example here, they're going to get about $11 million in annuity payments. At the end of that term, the remainder goes to you or other non-charitable beneficiaries. So with a 5 to 6% rate of return, there's about $16 million remaining for distribution under a 20-year term. And finally, let's talk about an irrevocable life insurance trust. This has been around for a long time. You have a lot of people use this. In it, you have an insurance policy. It gets transferred into a trust. Or the trustee can purchase a new policy. Cash gifts are made by you to the trust each year to pay for the policy premiums. Right now, the gift tax exemption is about $15,000 a person. So if you're married, $30,000 in premiums could be gifted to this irrevocable life insurance trust. The premium payments and the full death benefit of the policy are not included in your or your surviving spouse's taxable estates. So the insurance proceeds at death will be exempt from all income taxes. Let's see how it works. We've got a $5 million insurance policy on the husband. We're going to value husband's assets at $11.5 million and wife's assets at $11.5 million. So under current law, we'd be at about the $23 million threshold, and that $5 million insurance policy, cash value, would be taxable. So a husband's death, there's no taxes due. He gives $5 million to his wife. $11.58 million goes to the family trust, and wife's assets are $11.58 million. At wife's death, her estate totals $28.16 million. She's going to end up paying about $2 million in federal estate taxes due, and the beneficiaries will receive about $26 million. Using an irrevocable life insurance trust, $5 million policy again, husband's assets and wife's assets still at that estate tax threshold. Husband's death, again, no taxes due. The big difference here, though, is that at wife's death, we've got 28.16 in total assets, but 0 in taxes due because the irrevocable life insurance policy was holding those funds. So that's an extra $2 million at the federal level that's going to go to the family. If you also include state estate taxes, that savings becomes even higher. As I said, this is really the asset part of the presentation where we're talking about what you can do with numerous assets. Feel free to throw your email address into the chat box, and I'll shoot you this deck over to you so you can look at it, because we're going fast. Happy to answer questions on it. But what should you do next? Well, first you've got the asset size, right? The next thing to do is really focus on the income part. And for the income part, I'm going to turn that over to my compatriot here, Nathan Crampy. When it comes to the area of financial planning, many receive advice in 2 areas: investing and retirement. Nathan started his financial advising career providing great advice in those 2 key areas. Over the years, a shift happened in the type of questions that clients would come to him with. ones that got at the root of the client's needs and ideals. Understanding those needs, he formed his own firm, Lyons Wealth Management, with the sole purpose to help others lead a life of significance. Ultimately, this focus led to the establishment of the Lyons Index, which focuses on wealth enhancement and cash flow planning, wealth protection, charitable giving, wealth transfer, and tax planning strategies. In addition to investing in retirement planning, he helps select families lead a life of significance through a well-designed wealth plan. He's a certified financial planner. He's received the 5-Star Wealth Manager Award for the past 8 years. He's been featured in Minneapolis St. Paul Magazine, Wall Street Journal, Forbes. He's my friend. Please, and he's got a great name. So please welcome
Exactly.
Nathan Crampy.
Well, thank you, Nathan. And you're right. It is a great name. So what I want to do, Nathan took a lot of very, good deep dives into some things that are going on with planning techniques. Now, one of the questions I'm going to have for him, so I want you to hold me to this at the end here, is what's going to happen with a change of the estate planning kind of laws and how maybe a lower threshold may be to come. So we're going to be talking to that at the end here as part of our little more, call it a happy hour coffee time chat. But I want to kind of get into a couple planning opportunities and answer some questions you have about possible changes with the tax law to come. But before we get into that, holy cow, this has been an interesting year to say the least. We've had the coronavirus, which has made this a very interesting year. The elections, which, depending on your, kind of which side of the aisle you're on, may or may not have been good, but that also makes it a very interesting year. We had a stock market crash that happened, followed by an epic rally in the stock market. We had murder hornets in the U.S. Well, we are unable to travel right now with lockdowns. That's different than any time in history that I can ever recall. We've had wildfires. We've had Prince Harry quit the royal family. We're wearing face masks now. Kobe Bryant's death. The Summer Olympics have been postponed. Brexit, hurricanes, protests in Michigan over haircuts, and no spectators for sports. But one thing that is not on this list that I thought was very interesting: what to do. Do you wear a suit or do you wear sweatpants? And that is the most important question, because this question comes back to what the economy is going to do. And when we're taking a look at everything here, never before in my wildest kind of ideals did I ever think that we would be at a point where companies would say, get out of the office, go home. I don't want to see you, but I'm still going to pay you. So this is going to be a really interesting opportunity to come to see how the economy keeps progressing, and as people come back to the office, of the progression that we're going to see with the economy. But with that, I want to kind of dive into, again, the tax laws that are changing, because this really kind of bookends a very, very interesting year that we've had. So first up, I really want to talk about the corporate tax changes, but for many of you, that's not going to be as big of a deal. Right now, under the President-elect Biden, he is trying to make some plans and put them in place to raise the corporate tax. Now, under the Tax Cut and Jobs Act, we had lowered it to 21%. This is from 35%. So this makes us a lot more competitive on a world scale compared to other nations. What our president-elect is trying to do now is raise that not back to where it was, but just a small amount, from 21 to 28%. Now that's on basically C Corps. And most of you do not have a C Corp, but the one area that is going to be most impactful to you is going over and looking at that qualified business income deduction. Now that was part of the Tax Cut and Jobs Act, and what that really was intended to do is say you can, as a kind of flow through entity, whether it is your sole practitioner, LLC, S Corp, you can have a 20% deduction on your net income. So that was really designed to take into account a lot of things that were going on with the lowering of the corporate tax rate and how you could take advantage of it, so you didn't have to switch over to a C corp and have all the kind of the details that would be associated with managing a C corp versus say just a flow through entity. So that was the ideal. That is looking to be eliminated. So what that means for you is right away you would have 20% more in taxes. Now we're not quite sure where this stands, and going back to one of my opening comments, we have now a Democrat president, we have a Democrat-led House, but we're still waiting to see on the Senate. And if the Republicans maintain control of the Senate, most likely some of these tax law changes will not be enacted. However, is we don't know which ones. And this is one that is going to be interesting going forward. So I do think that this has a potential of actually making it. So I want to be aware of that. That's one of the law changes. Another law change that is coming that I actually think is going to be implemented is really coming back to Social Security. Now, right now, as it stands, you pay tax on your wages and earnings up to about 137,500-ish, somewhere right around there is what you actually pay Social Security and FICA tax on. So that would change though, and under President-elect Joe Biden's kind of proposals, that would still maintain, but right now as it stands, anything above that 137,500 range is not taxable for Social Security. So you can make $1 million of income and still be only having that $137,000 taxed when it comes for Social Security. Now, for those of you that are self-employed, obviously that's not only a 6.2% from your employee side, but you as an employer kick in the 6.2% to make the 12.4% for the total tax on that. What the new proposal would be is that that cap basically is going to be removed, but not right away on anything above the 137,000. There's going to be a hole there, and it's going to go up to about 400,000 that you're not going to pay any additional tax. But when you have $400,001 of income, that's where that tax is going to start in again. And so this is a big deal because not only do you have the Social Security tax, but remember all of the different taxes that come kind of out from that. So going back to that $1 million of income, first 137 would be taxed, 137,500 or so would be taxed. The next chunk would not be taxed at all for Social Security, but then anything over that 400,000 would be again subject to Social Security taxes. We're going to talk about some planning techniques here in just a moment when it comes to this, but I wanted to lay out some of the details as what the proposed laws are. Next one that we have is a potential for raising long-term capital gains. This one is very interesting. I don't know if this one is going to pass if we have a Senate that is controlled by the Republicans, but it's really interesting to know that this is what the potential is to come. Now, what this is showing here is that when we take a look at long-term capital gains, right now we have a couple different brackets. We have the 0% bracket, we have the 15% bracket, and at the top end, we have the 20% bracket. Now, split on top of that, we have the net investment income tax, which is 3.8% on top of it. So your highest amount that you would pay for your capital gains would be, your long-term capital gains there would be 23.8%. Under what President-elect Joe Biden is proposing is that he would make another bracket on top of that. So we would have what would be the 0%, the 15%, the 20%, and then we would have ordinary income. And he is already looking to make a new tax bracket itself, the 39.6% bracket that would replace the 37%. So we're going to increase taxes on the high earners. And then layer on top of that, if they have capital assets like this, long-term capital gains, then what that would also look like is we would be settling, instead of the capital gains of 20%, the 39.6%, On top of that would be the net investment income tax. So we could pay over 43% tax on the federal level, plus what you would owe on the state level. So this is a huge deal, and this is what we're going to be focusing more time on today, and what Nathan has been doing a good job talking about with some of the different proposals that we can do to mitigate some of these taxes. Last one that we're going to get to and talk a little bit about here is a step up in basis. So legacy assets. And again, this is some of the things that Nathan's been talking about a little bit earlier is going to flow through to this particular point as well. There's a proposal, and again, if the Republicans maintain control of the Senate, this may or may not happen, but it's good to know so we can have a plan in place if and when this is enacted. But what this looks like is any asset that you want to pass on. So legacy planning. Well, many of you have some very highly appreciated stock and investments, maybe some real estate, a lot of different areas there, but this in particular is talking about how when you pass on assets currently, it comes to the point that you would basically have it in your estate. You would pass it on, and let's take a look at a stock here, just with a highly appreciated stock. We'd pass it on to your beneficiaries, say maybe your kids, and they would get that with what's called a step up in basis. And what that means is the day they receive that asset from the day of your death, there's going to be no tax that's owed. The day of your death, the asset, the cost basis of what you purchased it for is going to come up to what is equal on the day of your death. Now, they're not going to owe any tax. Going forward, however, there may be some tax that's owed, but it comes back to your estate. That's who pays the tax initially. And that's where some of the ILET planning, some of the things that Nathan was talking about, actually is a very good thing to do if you have a lot of these highly appreciated stocks. However, is that under a new kind of law going forward, is if this passes, they're planning on doing away with this. And we don't quite know what that looks like, but at the first glance, what it may be is that they may decide we're going to have it as a deemed sale. And what that means is that they're going to take a look at it and say, well, all of that gain, we're going to have you pay income on. So on your death, you're going to pay income on that gain. Well, then you're also going to have that be still in your estate. So it could be subject to estate taxes. So possibly double taxation before it passes to your heirs. That's a really bad piece here that could really potentially be hurtful and harmful. So that's another planning piece. There are some other ideas surrounding this, but that's going to be the major one that's going to cause the most headaches that we need to be aware of. So those are kind of the four pieces. Now, I want to break this down planning-wise into three different areas. You can pay tax now, you can pay tax later, or you can potentially pay tax never. So let's take a look at this and some planning strategies to do now for this year, or even some subsequent years of how you can keep and continue to minimize your taxes. All right. So judging by kind of all the things I've just talked about with the capital gains, with whether it's a step up in basis, anything of that matter, one of the main things that we can work with here, first off, is we can pull forward some sales and revenue. Now, for those of you who are business owners, this may be a very good piece to pull through for this year, 2020, because what that would do is say the qualified business income deduction, you would still qualify for, no matter what, for this year. So if you have sales or you have customers that are looking to possibly purchase, try to get them to purchase this year, because then you can not only get the deductions, but the lower potential cost on taxes as well. Now, speaking of taxes, this could be a retroactive tax law. So it could very well be that it's enacted middle through 2021, but be retroactive to January 1st, 2021. So that's why it would be a good thing to get this done this year if you have the potential to do that. Another area that we can work with here, you can just sell your capital gains assets as well. So if you have long-term capital gains on some highly appreciated stock or other capital assets, maybe you just want to sell them outright. Pay the tax this year on a known capital gains with the 20% for investments with only the 3.8% net investment income tax on top of that. That may be half of what it'd be in the future. So that may be a good planning technique. Well, there's another technique here. We can sell and repurchase as well. So if it's something that you maybe is not necessarily highly appreciated for an asset, but something you want to be holding on to, you can purchase it right after you have sold it, and you can do that immediately. And then what that could do is say, raise your cost basis up so you have the ability to pay less tax going forward. Now, something Nathan didn't talk about a little bit is the charitable remainder trust. He talked about something else. He talked about the charitable lead trust, and that's going to be a question I have for him after this time here, is maybe there are some different planning techniques between the two, but I like both. I think in this instance, the charitable remainder trust may be a really good way to go about it as well, and this is where I need Nathan to kind of chime in here in a moment. But what is a good opportunity here is that maybe we do sell some stock this year and we realize those gains. Now, if you're very charitably minded, maybe we can actually take that and put it into a charitable remainder trust and get some of those offsetting charitable deductions. And this year in particular makes it an incredibly good year to do that, because with the CARES Act, we can get the SECURE Act and the CARES Act, then for this year only, we can get the 100% deduction. And that's not going to be that way going forward. So this may be a great year to do some of the planning techniques to try to mitigate a lot of these taxes as you're charitably minded. So that's a great way to maybe possibly pay some tax now to save yourself some in the future. All right, paying tax later. Well, a couple different options here. One of the options goes back to you as the business owner, knowing that we potentially may have higher Social Security kind of taxes coming with your income, and amounts, I should say, and knowing that you may have qualified business income deductions going away. Let's take a look again back at your retirement plans. Now, you can contribute to your 401k. And for those of you who are over the age of 50, that is up to $26,000 that you can contribute as the employee. And then they can actually go higher than that as well. So you can actually get up to $57,000 this year for 2020 that you can contribute to your plans, part of the employee and the employer. So that may be enough. But I'm thinking for many of you, that may not be enough to kind of make up the difference of some of that QBI deductions that you're going to be losing. Another good opportunity that many of you may already have in place or are considering would be a cash balance plan. Because what that does is not only says I can put money into my 401k, which you know, but now I potentially could put hundreds of thousands of dollars more. And for some of you, with your age and how much you're earning, you have a potential to put up to this year, for a single year, $343,000 in addition into this plan. Now, this is a tax me later type of a plan because it's just a retirement plan. We can put money away and then you can withdraw from it as you have the desire to in the future, or we can do planning surrounding this. So these are great opportunities for your business to save on income so we don't have to pay as much QBI or, well, income in general because of the fact we're losing a QBI deduction potentially. Another one, if you're looking to sell your business at any point in time, maybe possibly using an installment sale in the future versus getting cash right away, because that would allow you to defer over many years or even a couple of years the income versus just getting it all at once. That may lower how much you pay in taxes going forward. Private placement annuities. This is a great thing to look into, and annuities have their place. But one of the areas that I really like about this, especially for some planning surrounding some investments that you may have, we'd have to sell some of the investments to put into the annuity. But the thing is, you may not want to. So what makes a private placement annuity different than some of the other annuities you may know is, first of all, they're pretty low cost. But secondly, they have that tax deferred status. That's huge because when we put the investment or the cash in there and purchase the investments, and with these types of annuities, you can pretty much purchase anything you want with them. So the stocks that you have, anything that you want, you can be purchased in there. Well, if it's going to be appreciating quickly in the future, this is a great opportunity because we don't have to pay tax on the gains that we have. So we can be buying and selling along the way, moving into different assets without paying any gains, only when we take out of the account, or we can plan for it for legacy planning as well. Then the last aspect we can do is nothing. We don't have to do anything with the new tax laws. But as you're considering that may be a good road to take, I want you to just take a look at this chart. This chart is the federal deficit compared to our GDP. Now, what you notice is that all the way over on the right, it really is getting scary that we're running a 15% deficit this year comparatively to our GDP. And as you can see here, there's only been a few years going back to the late 1960s that we have not run a deficit. Now, why I'm pointing this out is, well, if we do nothing, we're hoping taxes don't really go up much. And I would submit that they may have to, regardless of who's in power in the future, because it may be needed just to keep our economy and our nation safe and secure. So, last one, possibly paying zero tax or no tax. There's a number of different options and planning techniques we can go down here. First one, we can just gift assets outright to family. And they have right now this year, and Nathan can come back and talk about this a little bit more, but gifting outright is a great strategy and can be a very, very good strategy to gift, especially to family members. Use up some of your gift tax exemptions so that you can remove that out of your own personal estate going forward. That's obviously going to not cause you to pay tax on that amount. Another one is we can gift to charities and get the deduction. And you can give assets. You don't have to just give cash. You can give assets as well. So you can give without selling. And that's going to be some other great planning techniques. Roth 401k. For those of you who are still have your company and looking for retirement plans, this is not one that is going to provide maybe, say, a lesser amount today in tax. But what this is going to do is actually really help in the future. And with the new tax laws, as taxes are going up, what this is actually going to do is give you a much greater benefit going forward, is going into the Roth, where we pay no tax on all of the money that's in there. So it's tax deferred and it's tax free when we take it out later on in retirement, or if we leave it as a legacy. So great avenues to be considered as well. We have Roth conversions for those of you who are retired, have some retirement plans. This year would be a great year to do it because we have low taxes that may be sunsetting out earlier than what we had anticipated. So doing a Roth conversion would pay a little tax today to basically forego paying a lot more tax in the future on especially assets that are going to be very highly appreciated going forward. And then Nathan talked about this a little bit, but life insurance trusts. You know, we can be structuring some of these life insurance trusts to pay the tax so that we have not only your estate, the assets you want to pass on, but we have the life insurance that's going to pay for the tax that would be owed on that. So these are some great planning techniques, and you can start seeing some similarities here as to, with the tax law changes that are potentially coming, how that can relate to the planning techniques. So that's a little bit of a very broad overview. Pay taxes now, pay taxes later, or potentially pay taxes never, or pay zero taxes in the future. So I want to end kind of the presentation part of our time today, and I want to open up. I'm going to stop sharing my screen. Nathan and I will be here, and what we would like to do is start answering questions. So call this more of a coffee or a happy hour time where we're just going to be here to answer questions you have. We may be able to answer specific situations and scenarios, but mostly we can talk about some generalities as well. So thank you for taking your time to listen, and we're here to open up for questions.
Nathan, while we're waiting for questions, I'm gonna circle back on the charitable remainder trust versus a charitable lead trust, and
Yes.
what the difference and why I put mine in one in versus yours. When I talked originally at the beginning about asset versus income, and you'd be talking income, the charitable remainder trust is really a great income strategy, where a charitable lead trust is a great asset strategy. And so what I mean by that is, with the CRT, we call it, you're getting income every year, with the remainder going to charity. With the lead trust, the charity's getting the income every year, and you're getting the asset at the end. So that's the big thing. If we want to make sure we're deferring income, we want assets low and income low now, then we push that into a CLT. If we want to be making sure that we're getting income now, but also taking a tax deduction for the charitable, then the CRT becomes a fantastic technique for us.
Yeah. No, that's a very good distinction, because as part of your planning, you may have some different strategies that you want to do, and one's going to be better than the other. So if you want to retain the asset, obviously the lead trust is going to be a better avenue, and we can get some charitable deductions along the way. If you need a big charitable deduction this year or today, the remainder trust would be a great opportunity. You would receive income, but we give up the asset. Now, both are great planning techniques. It just comes back to which one's going to be most appropriate for you.